Rigby, were there any matters announced in the recent federal budget that my clients should be considering before June 30?
I guess the major issue that comes to mind was the reduction in the concessional tax rates for superannuation contributions that come into play from the 1st of July 2009. That is, from the 1st of July 2009, the concessional deduction limits for superannuation contributions reduced from $50,000 to $25,000 if the taxpayer is under 50, and from $100,000 down to $50,000 if the taxpayer is over 50.
So, should my clients be taking advantage of the current concessional limits?
It really is a matter that they need to talk to their tax agent about or a client advisor, but really it's the last year in which we do have these higher thresholds, and I guess in this day and age it certainly is a prudent investment to make. We're trying to encourage all our clients to get as much into superannuation as possible, so I would certainly be talking to someone about it seriously.
With the reductions in the concessional contribution caps, I've been talking to a lot of my clients about transition to retirement strategies, which allows them to put money into super or salary sacrifice money into super and then draw a pension out to supplement the money they're putting in. The reductions in the contribution caps would probably need a rethink of that strategy, wouldn't it?
It certainly would. I guess it all depends on the pension amounts being drawn from the superannuation funds. I guess the strategy, when implemented at its best, you're drawing the minimum amount from your superannuation fund, because obviously we still want to retain our investments in the superannuation without depleting our assets. And generally any withdrawals you make from your superannuation fund, you're recontributing. So it would all depend on, I guess, the level of your accumulated funds in your superannuation fund, but certainly that could impact the amount you could recontribute as part of one of those strategies.
As people are getting to the 55 years and older age bracket where they can draw their transition to retirement pension, they really need to talk to their advisor and their accountant to ensure that their strategy moving forward is going to be the most optimal one for them.
That's exactly right. And I guess given that we can now draw these transition to retirement pensions at the age of 55 and still remain at work, having as much money in superannuation prior to getting to that age is certainly so much more advantageous.
Were there any other changes in the budget in relation to superannuation?
The government has also made an announcement in relation to superannuation that affects their co-contribution. That is, previously, if you were entitled to the full government co-contribution, if you made an after-tax contribution of $1,000 to superannuation, the government would match that with a $1,500 co-contribution. This measure is still in place for the 2009 financial year, but next year it will reduce to a dollar for dollar co-contribution. So if you contribute $1,000 to superannuation, the government will match that with a further $1,000 contribution.
Okay, so if we really want to take advantage of the 150% return on your funds, and you qualify for the full amount of the contribution, you should really do that by June 30.
That's exactly right. This is the last you will have those limits. The government has talked about reintroducing these limits. I think it's from 2012. But it's difficult to say what will happen in the future. But at this stage, this is the last year that you have got those limits.
Generally speaking, what tax planning advice would you be giving clients prior to June 30?
Dan, this is obviously a difficult question, and I get asked this every year. It really depends on the individual's client's circumstances, I guess, whether or not they're a salary and wage earner, whether or not they're in business, or in fact, if they are in business, whether they satisfy or qualify for the small business concessions. So there are a number of issues involved in any year-end tax planning, and I guess it really depends on the individual client.
Okay. Is it too late to do some tax planning before the end of the financial year?
It's getting very close, but no, it's never too late. Up to 30, we'll still be advising clients on various taxation issues up to 30 June.
Okay, Rigby, could you just tell me what constitutes a repair versus an improvement on investment properties, please? I have a lot of clients that ask me this question.
There's a number of issues. I guess with respect to rental properties, there's two issues. There's things which is called an initial repair. When you first buy a rental property, you might outlay some expenditures which actually are repairs, but you won't get a tax deduction for them. They'll be considered initial repairs and capitalised, and this is because that they don't relate to a period of tenancy, that those expenses don't relate to a period of tenancy.
Okay.
So if you were to buy a rental property and spent a couple of $1,000 throwing a splash of paint on and fixing a few stairs here and there, those costs would be capitalised and would come into any final calculation of any capital gain, but you won't get an outright tax deduction in the year they were incurred.
Okay.
General repairs and maintenance restore an item to its original condition, as opposed to being an improvement of an item's condition. So this is difficult to explain, and there's lots of case law on this, but obviously painting a house after it's been tenanted for 2 years would certainly be constituted a repair.
Okay.
Painting a fence would certainly be a repair. Replacing the pickets in a fence would certainly be a repair. Replacing an entire fence is probably a capital improvement and would need to be depreciated.
Okay.
So there's a number of issues involved with determining whether or not an item is capital in nature, which needs to be depreciated, as opposed to a repair. But if you can think of that, what am I actually doing? Am I restoring something to its original state, or am I improving it? And generally, if it's improving it, it's capital and needs to be depreciated.
So that's like if you've got a dilapidated kitchen and you think, I need to repair it, so I'm going to put in a new one. Well, that's not actually a repair, it's a capital expense because you've improved it.
That's exactly right. That's exactly right. And it occurs with floor coverings and things like that. Okay. So if you did have the floors carpeted and then you decided that that was too expensive and you wanted to have them tiled, because it would be arguable that's an improvement, and that would be on capital account as opposed to a straight repair.
Thanks, Rigby, that was great. I hope you enjoyed the presentation. Rigby will be online on my forum on Monday night, June 29 at 6:30 p.m. Go to www.myonlinewealthcoach.com.au to the news and tabs events to register, and he'll be able to answer any queries that you have. My Online Wealth Coach is completely unique in the financial services field, where we do not sell products or receive commissions. We only educate and motivate clients. We're a financial advisory firm that specialises in business and personal coaching. For more information, go to www.myonlinewealthcoach.com.au.